In this session, let's focus on inventories and the various valuation methods regarding the inventories, and how do these valuation methods typically impact the various financial statements, and from there how does they impact the financial ratios, because this is one of the important aspects which should be important for any financial analyst before he puts his numbers and calculations into the financial statement. So from that dimension, let's look at the perspective of inventories, what all an analyst should be considering while valuing inventories or while looking at the financial statement from the perspective of inventories. Now, as we all know, inventories have different valuation mechanisms, right? The cash flows with respect to inventories, which is primarily an allocation between the inventory in the balance sheet and cost of goods sold in the P&L statement. So these are the two things that are impacted with the various valuation methods. We know that we have a first in first out kind of a method, a last in first out kind of a method, a weighted average method, and also a specific identification method. So with each of these inventory valuation methods, how do the financial statements really get impacted, and how to build that, how to convert one financial model from the other, all those things we would typically look at right now. All right. Now, whatever is the mechanism that the company is following, there should be a consistency in the mechanism. Consistency is very much required, and that will help the analyst to do the comparison or the performance of the company across time and also with the peer companies. And once the method is changing, it will impact the ratios and hence probably the investment decisions also. So just to look at each of those valuation methods, when I am talking about FIFO, the first in first out. So the goods that are purchased earlier, they go into cost of goods sold, and the goods that are purchased later, means very recently purchased goods, they go into the inventory. So that is how the first in first out mechanism works. The recently purchased ones go into the inventory, whereas the old purchased goods go into the cost of goods sold. So the ending inventory, it reflects the latest and the current cost situation. So in case of inflation, especially the prices are going to go up, because the earlier prices go into cost of goods sold. Cost of goods sold may be lesser, whereas the inventory, which actually accommodates the later purchased goods, and because of inflation the later purchased goods are costing very high, the inventory will have a very big number. So when we are talking about the FIFO based valuation method, the cost of goods sold will be lesser. Cost of goods sold lesser could mean the profit before tax is higher. You need to be comfortable with this kind of understanding. The moment the cost of goods sold goes lesser, the profit before tax goes higher, means tax also can go higher, and finally the profit after tax, which is the net income, also may go higher. Whereas when we look at the inventory part, the inventory will be very high, because inventory is composed of the later part goods. So the inventory will be very high, which means the current assets will be higher, which means the total assets could be higher, and whatever the calculations that are based on total assets, they are impacted accordingly. Now, if at all the LIFO method is used, when I am talking about LIFO, last in first out, the last purchased goods, they go as a part of cost of goods sold. So cost of goods sold reflects the recent prices, and it is a good reflection of the current prices of the good. So in case of an inflationary environment, obviously this is going to be much higher. So if the cost of goods sold is higher, the PBT is lower, the taxes are lower, so the net income is also lower. Finally, this is the motivation factor for the companies to typically go for LIFO based reporting method, the tax benefit which can come up, because especially during the inflationary periods, I can easily assume that the cost of goods sold is going to go up, and when the cost of goods sold goes up, the taxes will come down because the PBT, profit before tax, will typically come down. So we can say that the ending inventory, which consists of older purchased items, so ending inventory will be a lesser value, so the current assets will be lesser and total assets will be lesser in case of LIFO based reporting method, whereas the cost of goods sold will be higher, which in turn means the taxes, the profit before taxes will be lesser, and thus the taxes also will be lesser. So the net income also falls drastically in case of LIFO method. And because the taxes are lesser, the cash flows are higher. The real tax which you are paying is going down. If there was no taxes, it would have hardly impacted the cash flow statement. The inventory valuation mechanism would have hardly influenced the cash flow mechanism. One thing, no taxes means no impact on cash flow, because it would have increased whatever is not a portion of cost of goods sold, it would have gone into inventory, and change in inventory also would have impacted the cash flows in the same way as the expenses. So probably, so because of that reason, what you find is, if at all there were no taxes, there is no impact on the cash flow statement. Only the P&L and the balance sheet will be impacted because of the change in the inventory valuation method. But because of the taxes, as the taxes are lesser in LIFO, the cash flows are higher, and vice versa. And when you look at the weighted average method, it is more or less even the cost of goods sold as well as the inventory, both of them will be in between the LIFO and the FIFO methods during an inflationary kind of an environment. So this is nothing but on a weighted average basis we will be doing the costing part. And if at all we are talking about specific items going into specific materials, so each raw material can be identified specifically with the element that is getting produced and sold, then we will be using a specific identification method to value the inventory. But whatever is the method, the typical formula associated with the calculation of the ending inventory is the beginning inventory or inventory at the beginning of the period plus purchases that are done during the period minus the cost of goods sold for that particular period. This is what is going to give you the ending inventory for that period. Once we take up a few numericals in this area, it becomes more and more comfortable for you to understand this process. Alright? Moving further, just a quick numerical to work out. Given the beginning inventory is 194 units at $5 per unit. So what is the beginning inventory with the company? The beginning inventory with the company is $970 worth. 194 units at $5 per unit was the purchase price. So purchases during the year, $7 per unit, 146 units at $7 per unit, $882. Alright, compute the profit to the company if it has sold. So revenue or sales, 242 units at $8 per unit. So the revenue does not change. So $1936 is the revenue. Now what would be the cost of goods sold when I go with FIFO? When I go with the FIFO, what is the cost of goods sold here? 194 units, I take them at $5, and the remaining 52 units or probably 48 units. 242 units are sold, 194 from the original and 48 from the new, which I have purchased at $7. So this is going to work out to 970 plus 296. So working out to 1266 as the cost of goods sold in case of FIFO, which is resulting in, assuming all other costs are zero, which is resulting in a net profit or net income of $670 in case of FIFO. And what would have been the inventory in this case? Out of 146, 48 are consumed. So 98 goods at the rate of 7, $686 will go as a part of the inventory. So the total thing 1266 go into the cost of goods sold and 686 go into the inventory. Let's say if I am going with the LIFO mechanism, what would be the cost of goods sold now? The latest ones go into cost of goods sold. So the latest 146 items at 7 go into cost of goods sold, and because 242 items are sold, remaining 96 items will be taken from the old inventory, thus taking the cost to 882 plus 480. So your cost of goods sold will become $1,362. So the net profit or net income in this case will become 674. Sorry, 500. The net income or net profit in this case is becoming $574, whereas the inventory in this case is the 98 items that are left at the rate of $5. So the inventory in this case will be reflecting the older one. So the older purchased items are going as a part of inventory. So 490 will be the worth of the inventory. So 1362 will go as a part of cost of goods sold, whereas 490 will go as a part of the inventory in this case. But when I am going with the weighted average kind of a method, first let's find out what is the average weight per unit, average cost per unit. 194 into 5 plus 146 into 7 divided by 194 plus 146. That is the weighted average cost per unit. How much is it working out to? 194 into 5 plus 146 into 7. That is the cost, divided by 194 plus 146. So the cost per unit is actually coming out to around 5.85. So we have 242 units that are produced, means the cost of goods sold is going to be 1417, and that is working out to the profit. The revenues are 242 into 8. These are the revenues. So the profit is going to be 1936 minus 1417, working out to 518. Now let's see, did we do something wrong with the FIFO method? The FIFO method, the cost of goods sold. The FIFO method cost of goods sold is 194 items at 5 plus 48 items at 7. So the cost of goods sold under, it's 1306. Somewhere I made a mistake. Okay, the 1306 is the cost of goods sold, means the profit in case of the FIFO method is 1936 minus 1306, which is 630. Whereas when I am looking at LIFO, all 146 first have been utilized with respect to 7, and the remaining 96 units at 5. So the cost of goods sold is coming out to 1502. Right, the cost of goods sold 146 into 7. Okay, here there are some calculation mistakes, so please ignore these. Okay, so 1502 is the cost of goods sold, which is resulting in a net income of around 434 using the LIFO approach. 630 is the net income using the FIFO approach, and 518 is the net income using the weighted average approach. And whatever are the remaining items, when I look at the inventory here, 98 items left at the rate of 5.85 per unit. 574 is the inventory here. 98 items left at the rate of 7 per unit. So 686 is the inventory as per FIFO. 98 items left at the rate of 5 per unit. 490 is the inventory as per LIFO method. So these are the various inventory costing mechanisms and the typical cost of goods sold, as well as the inventory values associated with each one of them. Alright. Now, the next important concept to look at in this case is the understanding of LIFO reserves. What do we mean by this LIFO reserves? What we see is, now any company can report its financial statements as per LIFO or FIFO or weighted average or specific identification method. In general, we see one of the first three methods. Any organization that is following a LIFO, any organization that is following IFRS, LIFO is not allowed under IFRS. So any IFRS based companies will start reporting their financial statements only using FIFO or weighted average, whereas the US GAAP companies can very well use LIFO also. And one more thing is, whenever any US company which is following US GAAP is using LIFO, it is mandatory to disclose the LIFO reserve as a part of its footnotes. As a part of its footnotes, it has to disclose what is called as a LIFO reserve, which is nothing but what is that excess. What is that excess in case the company discloses the inventory, reports the inventory using FIFO. So if it has reported 300 as the inventory using LIFO, now if at all it has reported under FIFO, assume that the inventory has to be 400. Then what we are saying is it has to show 100 as a part of LIFO reserve, saying that is the excess in case the company reports the financial statements using FIFO. So that's where we say the LIFO reserve is the difference between the ending inventory reported under FIFO minus the ending inventory reported under the LIFO, and it is mandatory to be reported. So based on that, any analyst can convert LIFO based financial statements into FIFO based. So whatever are the elements that are impacting the financial statements when you are reporting inventory using LIFO can be very well converted into FIFO, and then the companies which are even following IFRS can be compared quite comfortably. So that's one of the prime motivations of using a LIFO reserve. And the other important aspect that we are supposed to understand is the concept of LIFO liquidation. It's a very interesting piece. See, let's say a company is following LIFO. Now, if we see the last purchased items are going into cost of goods sold. So cost of goods sold is latest, but inventory is very old. Now assume the scenario that there is huge inflation. So prices are going up. So prices are going up and we are following LIFO. So any latest produced item, any latest purchase item will go as a part of cost of goods sold, logically speaking. Now Let's say by this time the company has accumulated some 150 items at the rate of $10 per unit, showing its beginning inventory is $1,500. Now let's say in this year 200 items were sold, but only 80 items, 80 raw materials were purchased at $25. So the last purchase will typically go as a part of the cost of goods sold. So what is going to happen? Out of this 200, because I have purchased only 80 this year, 80 will be costing at 25, but the remaining 120 will cost only at 10, because my inventory, whichever is a very cheaper value, will now come into cost of goods sold, because cost of goods sold should accommodate 200 items. Only 80 are purchased during this year, which means whatever I have purchased is much lesser than whatever I have sold. Whatever I have purchased as the raw materials is much lesser than whatever is the number of units that I have sold. So the cost of goods sold is reflecting only few items from the latest, whereas the large proportion of the items from the oldest, resulting in a very low cost of goods sold and thus resulting in a very high net income. But of course, there is the other side. Now my inventory has come down only to 30 units at $10. So next year it may be a problem because all my inventory got replenished and I may have to purchase items at a very high cost itself, which means there is no way I can reduce my cost next year, and my net income will fall quite drastically compared to the current year. So that's where we say, even though using LIFO liquidation, why are we calling LIFO liquidation? I'm trying to reduce my inventory which is priced at a much cheaper rate, because if the inventory is much cheaper and today the prices are much higher, I could carry the value of that inventory into cost of goods sold by not purchasing the raw materials in this particular period, turning out using the older valued or older less valued kind of inventory into the cost of goods sold this year, thus resulting in increasing in the net profits for the year. So analyst has to be very careful of the usage of LIFO liquidation in the process. So you are able to create virtually more profit in 1 year, but it is not going to be a sustainable thing, because your inventory balances are going to reduce quite drastically, making the scenario more complicated for the next period. Let's look at a small numerical based on LIFO reserve. A company used LIFO, so 200 as the ending inventory of year 1. So let me take year 1 and year 2. So 200 is taken as an ending inventory here, 350 is taken as ending inventory here, and it has also shown LIFO reserves of 75 and 125. So which means if it had generated the financial statements using FIFO, this inventory should have been 275 and this inventory should have been 475. That's one thing we have to be looking at. So the ending inventory as per the LIFO is nothing but the ending inventory as per the LIFO plus the LIFO reserve will give me the beginning inventory as per will give me the ending inventory as per FIFO mechanism. So LIFO ending inventory plus LIFO reserve will give me FIFO ending inventory. Okay. LIFO cost of goods sold was 2000 during year 2. Okay, cost of goods sold, let's find out. So by reporting using the LIFO mechanism, the company was able to report 2000 as a part of LIFO reserve, cost of goods sold, and we don't know what about in year 1. So logically speaking, if it has reported 2000 as the cost of goods sold for this year, so what is the way you can find out the cost of goods sold as per FIFO? The simple way to look at is cost of goods sold as per LIFO minus the change in the reserves is what will give me the cost of goods sold as per FIFO. The other way also is, okay, for the year 2, let's look at it. Year 2 cost of goods sold, ending inventory LIFO is equal to beginning inventory LIFO plus purchases minus cost of goods sold. So ending inventory as per LIFO is 350 is equal to beginning inventory, which is 200, plus purchases minus cost of goods sold is 2000. So from here I get the purchases as 2350 minus 200, giving me the purchases during the year is 2150. Now I will go with the FIFO mechanism. Ending inventory of FIFO, which is 475, is equal to beginning inventory of FIFO, which is 275, plus purchases 2150 minus cost of goods sold as per FIFO. Either of the ways I can follow. So based on this I will get cost of goods sold FIFO as nothing but 2150 plus 275, 2425 minus 475 giving me 1950, which is nothing but you can see it as cost of goods sold as per LIFO minus the increase in the LIFO reserve, which is 75 to 125. That's the increase in the LIFO reserve. So the difference increase of 50 is subtracted from the cost of goods sold reported under the LIFO method, giving me 1950 as the cost of goods sold as per the FIFO mechanism. So one clear thing that you have to be comfortable with, especially for the companies which are reporting their financial statement based on the LIFO method, is how can I convert that into a FIFO method for the calculation purposes as well as for the analysis purposes, right? So now let's see, if at all a company is following different kinds of inventory valuation methods, what all accounts or elements of the financial statements are impacted and to what extent they would be impacted. So for that we'll take one financial statements, and based on that let's look at the calculations overall. So let's do a simple conversion from LIFO to FIFO. If at all the company is following FIFO versus LIFO instead of LIFO, what kind of impact would it create as a part of the financial statements of the company? So once we do that, we can try to do all kinds of ratios, analysis, lot of other things on that data, which can give us more and more comfort in terms of the analysis aspect. All right. So let's go ahead with one example and try to convert a LIFO based financial statement into a FIFO based. So for that I have taken one financial statement. Let me push these things slightly somewhere this side, right, so that we can operate at this layer. Alright, so these are the financial statements for the 2 years, for the last 2 years, 2012 and 13 for a company, and the balance sheet, a very simplified kind of a balance sheet, and a P&L statement, some key elements present in the P&L statement, and it is known that this particular company is following a LIFO based financial statements. So that is the reason it has reported a LIFO reserve as a part of its financial statements. So now when we have to construct the financial statements based on the FIFO method, I will keep, okay, whatever are the things that are not changing or that don't impact. Cash may be impacted, so let me not disturb the cash right now. I will not the accounts receivables do not get impacted with the change in inventory, whereas the inventory can get impacted. So let's look at those things that get impacted, but those things that do not get impacted, I am taking them as it is, right? So we know that cash, the inventories, and okay, the cash, the inventories will get affected, and probably the net PPE will not get affected in any way, and the same logic can be applicable even to the total current assets. So as far as the balance sheet is concerned, none of these items will get affected. Probably current liabilities, no, they will not get affected. Long term debt, liabilities, share capital, up to here nothing will get affected, but it's the retained earnings that may get affected. So we'll keep on to the retained earnings. So which means there will be an impact on shareholders' equity as well as the total liabilities and the owner's equity part. And when it comes to P&L statement also, it's the cost of goods sold that get affected, the sales is not affected, whereas the depreciation and all these things, and in fact tax can get impacted. So probably just to start off, these are the elements, whatever the elements that I have not filled, especially the taxes, they will have an impact because of the inventory. The cost of goods sold will have an impact based on the inventory valuation method. And when it comes to the balance sheet, I see that cash will be impacted, the inventories will be impacted, and the retained earnings will be impacted. So these are the numbers that change. So once I am able to identify these numbers, obviously rest all is quite simpler to follow. In the sense I can compute the impact of the ratios and various other elements. So let me look at it in simple terms. To start with, okay, it is given that the LIFO reserve is 117 in this year. So the first year what I will see is, assuming in the previous year the LIFO reserve was 0, that is the base assumption I will start with. Assuming that the LIFO reserve in the previous year was 0, I will increase the LIFO reserve for the first year by, I will increase the LIFO inventory for the first year, the FIFO inventory for the first year by adding the entire LIFO reserves to it. I will add the entire LIFO reserves and I will try to increase the inventory, which is what will make it FIFO inventory for the period. So computing the FIFO inventory for each of this period, so 539 plus 117. So this is how my FIFO inventory becomes here, and this is what will be my FIFO inventory here. So I am increasing the inventory in both the cases by the extent of, I am increasing the inventory by the extent of the LIFO reserve that got created. And after that, look at the cost of goods sold. In the first year, because the LIFO, the inventory has gone up by 656, and I have assumed that the beginning of the year's inventory is 0, at least for the first year. So what is happening, if I had gone with LIFO for the first year, the beginning of the period inventory is 0 plus the purchases for the year, we don't know, minus the cost of goods sold for the first year is 2147, resulting in an ending period inventory. This I am looking at from a LIFO standpoint. The ending period inventory was 539. So based on this assumption, I am able to compute that the purchases that are done during the period was 2147 plus 539, resulting in 2686. That is the purchases. Now purchases will not change whether I am going with an inventory, whatever is the inventory costing mechanism that I am using. So based on that, now when I am going with now I have increased the ending inventory for both the years, right? I know now the purchases in each, now I can find out the purchases in the second year based on the ending inventory method. The purchases in the second year based on the ending inventory method is 620 is the ending inventory, 539 is the beginning inventory, plus purchases minus the cost of goods sold being 2211. So based on this, now I can use the same logic, say purchases in the second year. So probably let me put it here. The purchases, here I will do the calculation of purchases in each of the years using this logic. So the purchases in each year is nothing but the cost of goods sold plus ending inventory minus the beginning inventory. That is what is calling for purchases in the year. Cost of goods sold plus ending inventory minus the beginning period inventory in this case, which I am taking it as 0 in the first year. Whereas in the second year, the cost of goods sold plus ending inventory minus beginning inventory. So the purchases during this year are to the worth of 2292. Now here also I can very well find out what is the cost of goods sold now. When I want cost of goods sold, I can take purchases plus beginning inventory minus ending inventory. That is what can be considered as cost of goods sold for this period. So I will take the purchases during the year plus beginning inventory for this period minus the ending inventory for this period. So the cost of goods sold is actually coming down. And whatever we are talking about the tax here, because the cost of goods sold got increased, right? The cost of goods sold got decreased because of the change in the inventory levels. Now the tax has to get decreased accordingly, right? Because the profit is increasing now, the cost of goods sold got decreased. Now based on this, look at what is the kind of impact on the tax because of this cost of goods sold. What is the profit before tax? This minus the summation of these things. This is what is the profit before tax, which means when I am taking up the tax as the 20% of this profit, so the tax is coming out to 69.4, which is nothing but whatever is the change. If we see here the tax was 62, here the tax became 69.4. So the tax has actually increased by 7.4. And how did we get this 7.4? Whatever was the difference in the LIFO reserves, the difference in the LIFO reserves 38, I am simply looking at the 20% of that 38, working out to 7.6. I think here the difference is to the extent of 7.6. Okay, the tax here is 7.2. Here also cost of goods sold. Okay, so the tax is 20% on this 347, giving me a 69.4, and probably my net income is changing by this much extent. Net income is increasing. Now, what should I do? I am paying more tax here, right? I am paying tax in excess by 7.4. So, obviously, my cash position for this year should actually go down by that much extent. And coming to the last year also, the same scenario would have happened. In the last year also, the cost of goods sold was 2147, and if I had to compute the cost of goods sold as per the FIFO mechanism the last year, the cost of goods sold is nothing but the purchases in the year plus ending inventory minus beginning inventory. I am saying beginning inventory is 0, right? Our LIFO reserve was 0. That is what we have considered in the previous scenario. So I could directly consider. So in that case, what is coming out is the cost of goods sold If the inventory has increased by 117, I will look at decreasing the cost of goods sold by the same 117. So because the cost of goods sold decreased by 117, what could happen is the taxes now will be on this updated amount. So the profit before tax now is nothing but, this is the profit before tax. So the tax that is applied on this is to the extent of, on this the tax of this is applied. So basically 71.4 happened to be the tax in the first year. Alright. Now all I need to know is for this particular year, because I have converted it from LIFO to FIFO, how is it impacting my balance sheet? Here, to match now, okay, the net income now has become 285.6 to accommodate even the changing tax and changing the cost of goods sold. So obviously the increase, so whatever was the retained earning in the earlier period, probably this retained earning would have gone up by the extent of this difference. The retained earnings would have gone up by the extent of this difference, resulting in the retained earnings going up to 633, resulting in the net liabilities and owner's equity increasing to the extent of 4284. Now this cash I can very well bridge it up as the gap between the total liabilities and owner's equity minus whatever are the remaining elements as a part of my assets. As a part of my assets, whatever are the remaining elements that are there, I am considering that particular aspect. So finally saying my cash is down by the extent of 130, I mean from 157. If I had used LIFO, if I had used LIFO, my cash was 157, but if I am using FIFO, the cash has become 133.6, which is nothing but a drop by the extent of 23.4. And what is contributing to that drop? Whatever was the tax portion that is coming out. So the tax portion is completely different here. So from 48 we have gone to 71.4. In LIFO it was 48, in FIFO it has gone to 71.4. So that particular difference, which is 23.4, is getting reduced as a part of the cash here. The same logic I can apply now. From 62, this has gone to 69.4. Now that is the excess, and of course here when I have to compute the retained earnings, I will take the previous period's retained earnings, which is this particular number, plus the net income for this particular year. The previous period's retained earnings, I am looking at it as the previous period's retained earnings plus the net income for the year, taking the retained earnings to this particular number, and the same logic I can use for the cash here, which is coming out to 141.2, which is again a difference of, from 172 it has fallen to 141.2, which is again by the extent of 30.8, which is the summation of 23.4 here and 7.4 here. So the two tax differences that are getting added up, That is what is resulting in a net drop of cash from 172 to 141.2. So this becomes the adjusted financial statement, which is the conversion from the LIFO to FIFO method. And once it is converted, we can very well calculate whatever we want using this particular, finding out the comparisons and all these things. So in short, to start with, all I will be doing is I will increase the inventories outrightly, first step, right? By the extent of LIFO reserves, I will increase the inventory, and in the first year, I will decrease, I will change the cost of goods sold, and by the extent of the change in the LIFO reserve. So for each of the years, what I will do is for the cost of goods sold, I will adjust the cost of goods sold by the change in the LIFO reserve. So here the cost of goods sold is 2147 and LIFO reserve is 117. I am assuming that the LIFO reserve in the year before this is 0. So because of that assumption, I am decreasing the cost of goods sold for this year altogether by the extent of 117. So if the cost of goods sold is decreased by 117, obviously the profit before tax is going to increase by 117. So the taxes are going to increase by 20% of 117, which means the taxes are going to increase to 71.4, and because of that the net income is going to decrease by 20% of 117, which is 23.4. So based on that, so but the net income will still be decreased by the cost of goods sold, cost will increase by the extent of cost of goods sold, resulting in a different change in the net income. So the changes in the net income will be added up to the retained earnings based on the LIFO method to arrive at the retained earnings based on the FIFO method. And whatever is the difference, that is what we are taking as the cash. So this will give me the cash portion for the previous year, and the same logic I will extend it to the current year to arrive at the cash and the retained earnings and all the other calculations. So now once I have all this in place, I can very well compute the various interpretations of the financial statement, because once I have all these things, I can look at, okay, what is happening to the current ratio. Okay, now let's look at this current ratio. Basically under LIFO method what is happening, under FIFO method what is happening. So current assets, so I'll look at each of the years. So the current assets divided by the current liabilities is the current ratio beginning 0.87, ending current assets divided by current liabilities, it has increased from 0.87, it has increased to 1.03, whereas in the other case 1667 by current liabilities, so this has gone up to 1.15 from so what it is showing is from LIFO to FIFO, you see that the current ratio will typically be higher only. In case of FIFO, you will find the current ratio to be higher compared to that of LIFO. The reason being current assets will go up, and if the current assets are up, the current ratio is going to increase accordingly. Then we can also think of inventory turnover ratio. In the inventory turnover ratio, I am looking at cost of goods sold by inventory. Cost of goods sold divided by inventory in any of the years. So when I am looking at in the FIFO's case, cost of goods sold divided by inventory. So one way to look at is the cost of goods sold. In case of rising prices, the cost of goods sold will be lower in case of LIFO, whereas the inventory will be higher. So cost of numerator lower, denominator higher, both of them are going to decrease. Numerator is being lower, which is cost of goods sold. Inventory is higher, which is the denominator. So both of them are affecting the FIFO method, because in FIFO method we see that cost of goods sold is lower and the inventory is higher compared to the LIFO. So that's where in this method, in the inventory turnover for both the years, we will observe that cost of goods sold divided by the inventory. When I go with a FIFO based, LIFO based, I am getting 3.56, but whereas when I am going with a FIFO base, I am getting only 2.8. So inventory turnover wise in FIFO is much lesser compared to that of LIFO. Similarly, look at debt to equity ratio. In case of LIFO, even if I look at the latest one, okay, debt is not changing in both the things, but the equity is changing because of the change in the retained earnings. So the debt to equity ratio in case of LIFO is 0.26, whereas in case of the FIFO method, the debt is not changing, but the equity has gone up, which is resulting in a fall in the debt to equity. Equity will go up because the inventories are going up. Inventories are going up means cost of goods sold is coming down, and because of that the net income is going up, which will result in the retained earnings also going up. So what we will see is the debt to equity ratios will be higher in case of LIFO compared to that of a FIFO method. And when we are talking about gross profit margins, which is nothing but the sales minus the cost of goods sold upon the sales, right? Here also in case of LIFO method, the cost of goods sold will be slightly higher, especially in case of inflationary environment. So you see that the gross profit margin will be slightly higher in case of LIFO compared to that of a FIFO. Even here if we are seeing, because the sales doesn't change, but the cost of goods sold will be higher in case of LIFO, which means the gross profit margin will be lower in case of LIFO compared to that of a FIFO. Same thing will happen in case of net profit margin also. And even when we are talking of return on assets. So it's all about just analyzing what will happen if this goes up or something else goes down. That's the typical thing we do as a part of any of the analysis. So when I am talking about return on assets, which is nothing but net income divided by total assets, right? The total assets in LIFO are much lesser, and look at the net income in case of FIFO, the total assets are higher, right? And here if we see, the interesting aspect here is both of them, the net income is also higher and the total assets is also higher. But if the net income grows at a much higher rate compared to that of the growth in the total assets, you will find that in FIFO the return on assets is higher compared to the other. So it's not always that the return on assets will be higher in case of FIFO, because both the numerator as well as the denominator, both of them will be increasing at a similar rate. I mean, both of them would be increasing. So depending on at what rate each one is increasing, if the numerator is increasing more faster compared to that of a denominator, that is where we say that ROA is going to be higher. Otherwise the ROA is going to be much lesser itself. So some of the formulas that we have used, okay, when I am looking at FIFO cost of goods sold, simply from the LIFO cost of goods sold, subtract the increase in the LIFO reserves. Straightforward. Similarly, what will happen in case of net income is it will be an increase from the LIFO net income. So the LIFO net income will be increased by the extent of increase in the LIFO reserves times 1 minus tax rate. So the FIFO reserve also, the retained earnings also, I'll take the LIFO retained earnings plus FIFO reserves times 1 minus tax rate. So you can look at this kind of formulas, directly update the income statement and the balance sheet, and based on that you can compute the cash flow statement, or you can compute the ratios or any other calculations from there onwards. Then till now we have looked at the inventory costing mechanisms using the various approaches, and how a financial statement will be translated from one form to the other. Along with that, now we are trying to apply a conservative nature into the balance sheet preparation, and looking at what the IFRS and US GAAP talk about the representation of inventory in the financial statements, especially when there are write downs. Write down is typically a decrease in the value of the inventory, especially when there is a huge decrease in the value of the inventory as per the market. How do you accommodate that? So from that standpoint, we see that as per the IFRS, we look at valuing, we look at representing the inventory as the minimum of cost and the net realizable value. The net realizable value people look at as the difference between the, if at all I am going to sell the inventory today, what is the selling price? So if at all I am going to dispose of the inventory today, what is the market price for that inventory minus what is the cost of selling this inventory. It could be incurring any additional cost for selling this. So probably a marketing, advertising or transportation kind of cost for selling this inventory. The difference between the two is called net realizable value, and cost is the one which is coming either by FIFO or LIFO, any method that I am using. Now if I say by using this kind of a mechanism, I got the cost of my inventory as $300, whereas using this net realizable value, I got it as $280 during this period. Then I will not represent 300 in my financial statements, I will represent 280 as a part of the inventory, because as per IFRS, I will be using the minimum of the cost and the net realizable value. So 280 will be shown as the inventory in the balance sheet. Because there is a decrease of 20 as per this mechanism, I will absorb the 20 as a write down expense. So it's another additional cost that would be shown in the P&L statement. This is what I am calling as write down, because the asset will be showing only 280 now, the inventory will be showing only 280 now, and 20 would be consumed as the losses in the profit and loss statement, which will reduce my net income for this particular year. Now what the IFRS says is, if in the next year you find that the cost is 250, whereas the net realizable value goes to 270, what this is saying is, because you have written down for $20 in the previous year, you can write up the cost to the extent of $20 in the next period. So to whatever extent you have written down in the previous period, you can write your inventory by that extent in the upward direction. So under IFRS you can recover to that kind of an extent. Whereas when we are talking about US GAAP, it uses net realizable value in a slightly different manner. It says the representation should be the minimum of the cost and the market value. Whereas the market value, they say it should lie between the net realizable value and the net realizable value minus the profit margin. The market value should lie between those two elements, and if it is lying between those two, we are considering the minimum of cost versus the market value as a part of the inventory. And if at all we are writing down to the market value, the difference is absorbed as a loss in the income statement, but the thing is no write-up. In the next year, even if the market value is greater than the cost, I am not bothered about representing it higher in the income statement. That is what will become the problem. And anything higher, let's say here instead of 270 it has gone to 280. What it says is, because you have registered a loss of 20 in the previous year, you can book a gain of 20, but there was a gain of 30 here. So what it says is the other 10 you can very well represent it in the balance sheet as a part of the other comprehensive income. Right? So these are some of the things which are critical with respect to the inventory write-up. So write-up is limited to the extent of previous write-down in case of IFRS, but there is no write-up that is allowed in case of US GAAP. And whatever, whether you are following LIFO, FIFO, IFRS, GAAP, there should be a consistency in the method. And if at all any accounting policy has changed or any changes come out as a part of the following method, what is suggested is the last year's financial statements also need to be transformed as per the changed accounting policy and show what is the difference. Not only it cannot be happening like last year's financial statements you have prepared using the older policy and this year's financial statements you prepared using a newer one. If you are changing an accounting policy in this year, you re-prepare the financial statements of the last year using the changed policy and show both of them side by side for the comparison purposes for the analyst. That is what we also call as retrospective updating. So the previous year's financial statements you try to update using the current set of rules and practices, because every change has a very great impact on the profitability ratio, the liquidity ratio, solvency, which we have seen as a part of some of the calculations also. And looking at some of the important disclosures as a part of the financial statements, as a part of the notes, every company has to disclose individual breakups of raw materials, the work in progress and the finished goods for each of the years. Right? So there should be a clear breakup of the entire inventory. Now from an analyst standpoint, he'll see how these three are changing over the periods. If these two are increasing from last year to this year, it's an indication probably more and more projects and more business is coming, so there is an increasing demand. But if this part is increasing more compared to these two, it means I am not able to sell the product. Right? My finished goods inventory is increasing quite drastically compared to the other two. it is an indicator of a falling demand. And if this is growing more faster compared to the sales has grown only by 10%, whereas the finished goods have grown up by 20%, even that would indicate a big fall in the demand itself. And slowly it may so happen that these products may become more and more obsolete, and then I may have to dispose them off and book big losses also. So all these things analysts should be very much aware of and try to get into a detailed understanding of each of these aspects to put as a part of his financial report. So he should be aware of the industry trends and management intentions. So going through the management discussion and analysis regarding the inventories, as well as the projected sales of the company, the projected profitable avenues for the company should be looked at before getting into a assessment or evaluation of the company for investment purpose. All right. So from this statement or from this presentation, it should be comfortable for you that regarding the inventories, how they are valued, what are the costing mechanisms involved, how would it impact the financial statement, and from a comparison purposes, if at all I have to convert one form to the other, what is the mechanism to be followed, and finally what are the important disclosures as a part of this inventory valuation system. In case you have any further queries, you can get back to me by giving me a call on the number that I have provided below. Also, you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.